In the home stretch of the 9-year bull market. That's how Tom Stevenson, investment director at Fidelity International, begins his first investment outlook piece for 2018. Tom joins us now with more. Tom, welcome.
Hello.
How long is this home stretch likely to be? Any clues?
That is the question. I mean, if you look at technical analysis, sometimes you get sort of 3 upswings in a bull market, and often the middle phase is the longest, but the final phase, which is where I think we are now, can be the most exciting. It can, give the best returns. So it's not a time that you want to be out of the market, but it can be quite short and sharp.
Yeah, sometimes that last phase as well can be very emotional. What was driving the markets in 2017? Because that came up in a surprising way, I think, didn't it? The gains we saw.
Yes, I mean, I think, what we had in 2017 was a continuation of very easy monetary policy and a lot of expectation and hope for what the Trump regime might do in terms of tax reforms, which of course we had to wait for the whole year to get, but we did at the end of the year. And I think looking forward, that's what's driving the market at the moment, is the expectation that those tax cuts are really going to extend the upcycle in corporate earnings.
Yes. Quite often, as I think you've alluded to, that we don't really want to get caught short in these markets. It's very difficult to know precisely, obviously, as you say, how long it's going to last. I mean, do you see all of 2018 being a potential for the market upswing, or do you see potentially something over the summer changing things? This is a graphic that you put together showing how bull markets have compared over the years.
Yeah, so I mean, so the line, the current bull market is that dark blue line, which is, so it's the second longest bull market, and in fact it's the second greatest in terms of gains for the market. So, arguably the bull market is quite long in the tooth. I think though that it's got further to go, and the reason I say that is that bull markets don't really die of old age. They tend to be murdered by central banks. If you think that we're going to have a bear market this year, you have to assume one of 2 things. You have to assume that we're going to go into recession, which I don't think we are, or you have to assume that central banks and the Federal Reserve in particular are going to raise interest rates more quickly than we currently expect. Now that is a possibility, and I think that is where the doubt lies about this bull market, because there is a danger, I think, that the tax reforms are pouring fuel on an already smouldering fire. I think the US economy is really picking up. In fact, the global economy is undergoing a pretty synchronized upturn, and I think adding tax cuts to that endangers a return of inflation, and of course that would lead to interest rates rising more quickly.
As much as inflation is going up, wages aren't going up that much though, are they?
No, that's right. I mean, if you look around the world, the inflation fears are just that. They're fears. It actually, you can't really see it much. And the chart here shows wages, and indeed they are bouncing back, but at a still, by historic standards, a relatively low level of growth. So I think that if the tax cuts do drive activity, the unemployment rate is relatively low. It's at a level at which in the past wage inflation has picked up. So I think that is probably the biggest risk to markets this year.
Going back to where the markets are at the moment, in terms of where we are with regard earnings, clearly we're entering, I think, now the 4th quarter earnings season in the US. We've just begun that. Do you think that earnings are going to give validation to this rise in the markets that we're still seeing into 2018? Well,
that is the expectation. I mean, I think we're looking at, low double digits, maybe 10.5% earnings growth in this 4th quarter earnings season. That's good, but it's necessary. If you look at the valuations of the markets, we see here that, on a historic basis, PE ratios are relatively high. In fact, they haven't really been higher other than in that really rather extraordinary market around the dot-com bubble. So, I think earnings is coming through. That's a good thing, but it is required.
Yeah. What are the risks here to where we are in the markets? Getting caught the wrong way, presumably.
Well, I think that at this stage in the market, one of the biggest risks actually is missing out, and that, of course, is that fear of missing out which drives markets in the final phase of the bull market. So I think there's a risk in missing out, but of course, catching the top of the market is near impossible. You are almost certainly going to be a bit too early or a bit too late, both of which can be an expensive place to be. So I think timing the market is tricky. I think valuations are demanding, and I think there is a risk on the interest rate front.
Okay, all right, interesting picture. Thanks so much indeed for joining us. Tom Stevenson, Investment Director at Fidelity International there, with a look at 2018 and some of the risks as we begin out in the meat of the year. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.